This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, June 30, 2026, and this is the New York session. Now, let's get into it. The S&P 500 is up 1.65%, but don't let the green ink fool you. The market is splitting down the middle, with technology stocks surging while small caps and industrials bleed out. It's a K-shaped divergence in real time. As of 12:35 Eastern, the QQQ is up 2.49% to $724.08, while the Russell 2000 is in the red at $298.97. Let's unpack the mechanics of this bifurcation. Before we dive into the tape, here is what is moving the needle today. The primary catalyst is the earnings print from Nike. Estimates are sitting at $0.11 per share, and this report is being watched closely as a barometer for consumer spending strength and confidence. A miss here could exacerbate the weakness we're seeing in the cyclicals. Also on the docket is StoneCo, reporting an earnings per share estimate of $3.22. We'll see how those results interact with the broader risk sentiment.
Nike is the litmus test. If consumer discretionary cracks, it validates the bearish case for the small caps. If it holds, it gives the tech rally some breathing room to extend.
Let's look at the broader market snapshot. The SPY closed near its daily high at $741, within its 10-day range of $716.58 to $756.68. The diamonds is lagging significantly at $521.68, up just 0.76%. The divergence is stark. The QQQ is pushing toward its 10-day high of $745.45, while the IWM is trading near the lower end of its 10-day range of $288.93 to $301.50. Sector rotation is the key theme here. The technology sector is up 2.37% to $185.41, while the materials sector is down 1.82% to $50.66. Healthcare is leading the weekly trend with the healthcare sector up 7.12%. Let's start with the biggest mover, the Nasdaq 100. The QQQ is at $724.08, up 2.49%. It's approaching the June 25 high of $726.83. Grid, what does the structure look like here?
It's a high-probability technical breakout structure, but it's fragile. We're seeing a volume surge that signals institutional accumulation. The QQQ is currently trading at $724.08, and the 10-day range expansion from $702.81 to $745.45 indicates heavy buying pressure. However, we are bumping up against the June 25 high of $726.83. If we don't clear that level with sustained volume, we confirm a bearish reversal pattern rather than a continuation. The SPY is consolidating at $741, which suggests the broader market is waiting to see if this tech break holds.
I'd challenge the idea that this is a pure bull market continuation. The VIX is compressing to 18.41, which suggests complacency. We have a severe bifurcation of sentiment. QQQ is up 2.49%, but the IWM is down 0.29%. This isn't broad market euphoria. It's a defensive rotation into quality. The yield curve is flat at plus 0.28 percentage points, signaling caution. If the QQQ rally stalls at $726.83, that low volatility environment could flip quickly.
And we have to look at the breadth. The technology sector is up 2.37% today, but it's down 3.51% for the week. This is a technical bounce, not a trend reversal. The rally is concentrated in a handful of names. Look at ENF. It's up 11.5% because it joined the Open Compute project as a platinum member. That's a specific AI infrastructure catalyst. But Apple is down 0.43%, and MU is down 0.33%. The mega cap index isn't carrying the whole sector. This is a narrow, catalyst-driven squeeze.
So, is this a breakout or a bull trap? SPECTER, you've been watching the macro risks closely.
It looks like a bull trap. The 10-year 2-year spread is flat at plus 0.28 percentage points, which is a classic precursor to economic slowdown. With CPI at 4.17% and core PCE at 3.41%, the Fed funds rate at 3.63% is restrictive. You are seeing a flight to quality in the tech sector, but it's being funded by a flight from credit risk in the industrials. The materials sector is down 1.86% for the week. The valuation of high-duration assets like the QQQ is under pressure from sticky inflation. If yields spike further, this technical breakout in the QQQ will revert.
Let's pivot to the lagging side of the K-curve, the S&P 500 equal weight or the Russell 2000. Let's talk about the IWM. It's at $298.97, down 0.29%. Grid, where is the support?
The IWM is trading near the lower end of its 10-day range, which is $288.93 to $301.50. It's in a low-volume drift. The structure is weak. There's no institutional accumulation here like we see in the QQQ. The 10-day range shows it's trying to consolidate, but it's failing to hold the midpoint. If it breaks below $294.68, the 24-hour low, we could see a test of that $288.93 support. The relative strength is entirely absent.
That weakness is a leading indicator. The IWM is the only major index in the red. It's reflecting the reality of the flat yield curve. When the curve flattens, small caps get crushed because they are more leveraged and sensitive to credit conditions. The 3.63% Fed funds rate is keeping pressure on their balance sheets. This isn't just a technical correction. It's a fundamental repricing of credit risk.
It's also a reflection of earnings quality. While tech is getting multiple expansion from AI narratives, consumer discretionary is facing headwinds. Look at DLR. It's down 4.7% on downbeat Q2 earnings. The market is punishing companies that don't have a clear path to AI-driven margin expansion. The IWM is catching the fallout from that rotation.
Let's talk about the sector that is actually leading the weekly trend, healthcare. The healthcare sector is up 7.12% this week. CIPHER, why is capital flowing here?
It's a defensive play within the rally. While tech is breaking out, capital is fleeing cyclicals for safety. The healthcare sector is the beneficiary of that flight to quality. It's not about growth here, it's about capital preservation. The rotation from the materials sector and the energy sector into the healthcare sector confirms that institutional money is de-risking. They are taking profits in the high beta names and moving into defensive quality. It's a hedge against the macro slowdown that SPECTER flagged.
The sentiment data supports this. New sentiment for NVDA is positive, Google is positive, but the broader market sentiment is fragile. The VIX at 18.41 is low, but it's masking the fear in the small caps. Investors are using healthcare as a shield. It's a classic risk-off signal within a risk-on price action. Let's look at the specific catalyst driving the tech sector, ENF. It's up 11.5%. CIPHER, break down the flow.
ENF is the anchor for this AI infrastructure narrative. It joined the Open Compute Project as a platinum member to advance AI data center power standards. That is a direct link to capital expenditure in data centers. This specific news flow is the dominant driver for the technology sector today. It's not just a generic tech rally, it's a structural shift in how the market values power infrastructure for AI. Compare that to FSLR, which is up 3.9%, capturing solar energy momentum. The market is rewarding companies with tangible links to AI build-out, not just speculative growth.
Technically, that volume surge in ENF is confirming the breakout. The price action is decisive. It's breaking resistance on high relative strength. This is the kind of leadership that supports the broader QQQ move.
But is it sustainable? The underlying macro environment is hostile. If the yield curve flattens further, even ENF will face pressure. You can't ignore the 4.17% CPI. Eventually, the cost of capital catches up to the narrative.
Finally, let's look at the consumer discretionary risk. Nike is reporting today. Earnings per share estimate is $0.11. Apex, what happens if they miss?
If Nike misses, it confirms the K-shaped divergence is actually a divergence in economic health. The tech rally is being supported by AI capex, but the consumer is weakening. A miss would trigger a re-evaluation of the materials sector and IWM weakness. It would validate the bearish case for cyclicals. If Nike beats, it temporarily extends the QQQ rally, but the macro realities of sticky 3.41% core PCE will still reassert pressure via the yield curve. The risk is asymmetrical to the downside.
So we have a market split. Tech is breaking out on AI infrastructure, but small caps and industrials are lagging on macro fears. Grid, CIPHER, SPECTER, let's wrap this up. What is the tradable insight right now?
Monitor the QQQ at $726.83. A volume-backed break is the bullish signal. Failure to clear it confirms the reversal. For the IWM, the $294.68 level is the line in the sand.
Trade the catalyst, not the index. Focus on the fundamental links to AI infrastructure like ENF. Monitor NKE's earnings per share print as the litmus test for consumer confidence.
Watch the 10-year 2-year spread. If it widens beyond plus 0.28 percentage points, the quality trade in QQQ will revert to risk-off. The credit stress is the hidden risk.
It's a fragile regime. Grid flagged the technical breakout in QQQ, but CIPHER showed the narrow breadth, and SPECTER highlighted the macro headwinds. The market is pricing in a soft landing, but the data shows credit stress and inflation rigidity. The setup favors a continuation of the tech rally only if NKE earnings hold. Otherwise, the lack of breadth in IWM and the materials sector suggests the QQQ breakout may be a short-term liquidity trap. The strategy is long QQQ/the technology sector, short IWM/the materials sector, and hedge with the healthcare sector/the utilities sector. But watch Nike closely.
Key takeaways: the S&P 500 is up 1.65%, but the rally is narrow. Tech is breaking out, but small caps are lagging. Nike earnings are the critical catalyst, and the yield curve remains flat, signaling caution. We'll be back tomorrow with the next update. This is ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.